Welcome back to the Value Investors Club. I'm your host, Timo Wunderlich. Let's get right into it with VIC readings, the form where we look at the best of the best value investment recommendations by the best of the best value investors out there. Today we have PRIMERICA Inc., ticker is PRI, price at the point of filing is $172. Let me first say this is no recommendation, not advice. Please do your own diligence before investing into anything. Let's get right into it. Thesis. PRIMERICA is a highly attractive business disguised as a life insurance company. It has a simple model: recruit and retain agents, sell policies, generate cash flow, and repurchase stock. PRIMERICA is more of a capital light, fee-based distribution business than an asset-intensive life insurance company. PRIMERICA relies on a unique distribution model to effectively address an underserved population of lower and middle income households. Even though PRIMERICA sells lower priced policies, it is a good business that has generated a 20% return on equity over the past decade. This is a high quality business for a few main reasons. Premiums are recurring in nature with policies that last 10 to 15 years on average. Sales expenses, which make up 35% of total costs, are variable because the representatives get paid on only what they sell. Furthermore, because mortality rates for large populations are predictable over time, PRIMERICA's underwriting is consistently profitable. PRIMERICA's clear competitive advantage results in a durable, consistent, high-quality cash flows. Since its IPO in 2010, the company has retired 49% of its shares outstanding. The company has grown EPS at a 16% annualized rate over the past 12 years, and I expect double-digit EPS growth going forward. Company/industry background. PRIMERICA is a leading provider of financial products for lower and middle income households in the US and Canada with 130,000 licensed sales representatives. The company underwrites term life insurance and distributes mutual funds and other financial products on behalf of third parties. Unlike most financial institutions, PRIMERICA focuses on underserved consumers. The company's clients are generally households with less than 100,000 of annual income that have inadequate or no life insurance coverage and often need help with retirement goals. PRIMERICA relies on a unique distribution model to effectively address this population. The commission or fees earned on this business aren't enough to support a traditional branch network, a marketing budget, or a fixed salary employee base. As a result, PRIMERICA uses a grassroots, commission-based, part-time sales force that would be difficult and costly for a potential competitor to replicate. PRIMERICA was founded in 1977 before becoming part of Travelers and then Citigroup in the 1990s. Although Travelers Insurance was spun off from Citigroup in 2002, PRIMERICA remained a part of Citigroup until it IPO'd in April 2010. The company has two segments: term life and investment and saving products. Term life makes up 60% of operating profit, and investment and savings products make up 40%. Importantly, both businesses leverage PRIMERICA's sales force. Competitive advantage number one: grassroots distribution. PRIMERICA's key competitive advantage is its 130,000 person licensed sales force that looks much different than the sales army of the typical financial institution. This sales force of independent, commission based reps gives PRIMERICA a competitive cost advantage in selling financial products to middle income families. The sheer size of PRIMERICA's sales force is not replicable. In fact, for most life insurance companies, term life insurance is a loss leader product, while their focus is on more profitable variable annuities and whole universal life products. PRIMERICA can sell term life insurance profitability because its representatives predominantly work part-time to generate supplemental income, getting paid only on what they sell. PRIMERICA's representatives are like franchisees who can build their own independent financial services businesses, leveraging the company's training, marketing, sales tools, and business management systems. As PRIMERICA puts it, you're in business for yourself, not by yourself. The costs associated with becoming an independent PRIMERICA representatives are relatively low and primarily offset the cost of obtaining a life insurance license, including pre-licensing training, exams, and license appointment fees. New representatives pay a one-time fee of $99 plus $25 per month. PRIMERICA is attractively compensated for its strong distribution while maintaining a variable cost structure, which results in a stable operating margin. Competitive advantage number 2, targeting an underserved market. Primerica's other advantage is that it hunts where others don't. Primerica's clients generally have $30,000 to $100,000 of household family income. Primerica's average face amount of term insurance issued was $335,000 in 21. For comparison, in the United States, the most common term life policy is a 40-year-old buying a 40-year-old buying a 20-year $500,000 policy. And Lincoln Financial, a competitor, issues life insurance policies with an average face amount of over 1 million. By having a sales force that targets an underserved market, Primerica faces less competitive pressure than if it sold to a more affluent population. Resilience. Primerica is resilient because of its recurring premiums, its variable cost structure, and its predictable claims pattern. The beauty of this business is that it benefits from persistency. Primerica has a life in force of $913 billion that requires minimal ongoing sales or operating expenses maintained. Even if no new policies were written, it would take nearly 15 years for this base of business to run off. Even if they wrote no new business, I estimate they could earn around $50 per share cumulatively, or 35% of the market cap over the next 6 years. Concern 1. Life insurance products and accounting are complex. Primerica is a much different than traditional life insurance companies. Unlike other insurance companies, which make most of their money selling complex annuities and whole life insurance, Primerica focuses on long-term life insurance. The company's motto is buy term, invest the rest. Primerica's business model looks much different than other traditional life insurance companies. Effectively, Primerica is capital light and compared to its peers. It generates almost no profit from investment income, and its investment assets to equity ratios well below that of comparable companies. One of the main reasons for this is that Primerica reinsures more than 85% of its mortality risk. As you can see in the chart below, this has been coming down slightly over time as a pre-IPO co-insurance agreement rolls off the book for legacy business. But Primerica expects to reinsure between 80 to 90% of the mortality risk going forward. Effectively, Primerica retains the value-added profits associated with distribution and minimizes the risk associated with investment assets and mortality rates. This aligns its profits with its competitive advantage and reduces uncertainty. Concern 2. Can't this be disrupted by tech? You would think, but but the key concept is that life insurance is sold, not bought. There's already plenty of ads for life insurance, and if you seek out life insurance on your own, you don't need to go through Primerica. That's existed for years. Tech disruptors aren't revolutionaries. This also goes back to the size of the policies. The customer acquisition cost of capturing a low price policy is similar to the cost of capturing a high price policy. People who are purchasing lower priced policies also don't tend to be as financially literate as so they need more hand holding and convincing. If you were a tech company, would you try to disrupt PRI for a $300,000 policy, or would you try to disrupt someone for a $3 million policy? Let's think about the cost of acquiring for a competing insure tech company. The commission on an average term life policy is around $1,000 and $500. Advertising for insurance on Google costs about $300 per click. If you assume a 10% conversion rates, clicks per purchases, that's about $3,000 in advertising costs alone. For a high price policy, that's a good investment. But for a lower price policy, it is not, as the advertising costs alone are about double the commission Primerica pays its representatives. Concern 3, multi-level marketing. This business has been around for 40 years and has continued to grow. If it was that bad for the employees, would the business model work this well for so long? Another argument that makes this different from Herbalife is that with Primerica, you don't need to purchase any inventory like you do with Herbalife. So the possibility of actual financial loss from signing up for Primerica is limited to $49 to $99. You pay for the pre-license registration. And there's a lot of longevity for a large portion of the sales force. 26,000 agents have been with PRI for 10 plus years and 10,000 for 20 plus years. Concern 4, capital allocation. Primerica's capital allocation has historically been excellent, but in 21 they did a suboptimal acquisition. But management took prompt action, acknowledging their misjudgment and minimized the subsequent capital investment into the business. This was a rare mistake and the company's first acquisition in over 10 years since the IPO. Going forward, I expect Primerica to return to share buybacks as the key component of its capital allocation strategy. Senior health business acquisition detail. eTeleQuote is a senior health insurance distributor of Medicare related insurance. Medicare probably. Wrong written. Related insurance. Primerica it was long looking for an adjacent business that could leverage its massive sales force. The thesis was that Primerica's representatives could generate low costs leads for eTeleQuote agents. If successful, this would be a win-win for both Primerica's sales force, who would have an additional product to promote, and for eTeleQuote's agents, who would get incremental referrals. I don't love eTeleQuote for two reasons. Number one, it consumes cash and will continue to for the next 5 years, despite accounting for about 10% of earnings. And number two, only 10% of leads are expected to be generated by Primerica's sales force, so it will operate in a competitive market where they don't have as clear of a competitive advantage. And within the first year of ownership, Primerica realized that the Medicare referral business turned out to be more competitive than they expected. Most of the leads for a eTeleQuote won't come from PRI agents. In 3Q21, just 1.5% of submitted applications were sourced by PRI reps. Over time, they expect that to increase to 10%. That means that eTeleQuote is using Google or other media to generate leads, which is very competitive and doesn't exhibit the same type of stickiness that the PRI rep has with people in the community. Management is pretty clear that this was a one-off deal and are already back to share repurchases after a less than 1 year pause. Going forward, eTeleQuote is not expected to consume any of the company's future cash flows. The numbers and key modeling assumptions. The company has grown EPS at a 16% annualized rate over the past 12 years, and I expect double-digit EPS growth going forward. In part, this is due to a technical tailwind as the company runs off its pre-IPO business, which contractually utilizes a high level of reinsurance. As a result, Primerica's term life premiums should grow at about 6% per year above the 4% expected life insurance in force face value growth. Margins should be similar to past levels, supported by Primerica's variable cost structure. PRI trades at 11x earnings, and I expect to grow 10%. I expect it to grow 10%. The stock has 50% upside. Catalyst, EPS growth, buybacks, and pack the briefcase for work execution. Thank you very much for tuning in. See you next time. Please write down in the comments below what you think of this idea. I think it's great. I think it looks great. I'm not too keen on insurance. I don't know enough about it, but this idea sounds that attractive that I might need to learn more.